Hello, everyone. Welcome to the CSUF Private Equity and Venture Capital Club. My name is Nicholas Kelly, and I'm the founder and president of the club itself, as you can see here. And so for our first presentation, I put together kind of an intro to private equity. Now, if you're not familiar with me, I have a separate presentation and kind of an introduction to how I know the things that I do and who I am. As part of the club, you can always just come up and talk to me if you have any questions. Now, I am by no means an expert in this field. However, I am certainly trying to be. So all of this information that I get is from publicly accessible information online. And also, I have been mentored by a few VC firms, namely Type 1 Venture Capital and Adventus Venture Capital Management. So I'm going to get started with this presentation, and I hope you enjoy. So here I've listed some of the different types of equity. Right now, I think that the most familiar one that you are probably familiar with is public equity, but there are also private and venture capital. Now, these are they are definitely related. As you can see, venture capital is actually a component of private equity, but they are different enough to where I put it in a completely different section of the Venn diagram. So I've listed some of the similarities and also some of the dissimilarities here. As you can see here, the venture capital section. So venture capital is typically the highest risk with the highest potential for returns. And that's because they invest in startups and early stage companies. It is a subset of private, so it is private equity. So that means that it's not listed to the public. And it's looking at the cutting edge. So this is like usually technology focused. You think Silicon Valley, you think, Tel Aviv, Israel, all of those super innovative companies coming out with crazy stuff that we barely even understand yet. Yeah, that's venture capital, but that could also be part of private equity. But private equity is actually a lot bigger than venture capital. There's a lot more sizable institutions that work in private equity. But I put the large firms and institutions and investing in the center because there are large venture capital firms and there are large private and public firms. As you may know, you're familiar with some of them. You think Vanguard, you think Spider, you think all those other ones, ARC, that invests in the public and private sectors. And just because a company is a public firm or a private firm doesn't mean that they can't invest in any of the other ones. So you'll see a lot of cross-sectional investing amongst all firms. And I think that good firms invest in pretty much everything. There's not really, any reason to not look into venture capital or private or public once you get to a certain size, because there's always going to be money moving throughout the entire system here. So you can watch a slideshow back if you'd like to go over each of these individual sections here just to kind of see what the similarities are. Here we have LBO. LBO means leverage buyout. And what that is when a private company typically tries to acquire 100% of a company, they leverage themselves with a little upfront capital and they buy out the company. Now, this can be a very risky thing, though, because if the company ends up going bankrupt or is unprofitable, they kind of just screwed themselves financially, as you see with a lot of companies that are over-leveraged, such as, we'll use Archegos Capital Management as an example with Bill Huang, I think they leveraged themselves 5 or 20, I can't remember, Exxon on I think it was Viacom and Discovery, and they went bankrupt. They lost like $20 billion in the blink of an eye, and that's horrible. Now, something I want to talk about with all of these different equity types is that there's always going to be risk in any type of investment. So that's, but it's all relative. So while public I would consider as the least risky investment, that doesn't mean that there's no risk when it comes to public investing. You'll see companies go bankrupt even if they are publicly invested. Publicly investable. That doesn't make them any safer, but typically if a company has made it public, that means that it is a little bit more, promising than a private company. However, we'll get into, later on, we'll get into more reasons why, you got to keep your eye out for some of these things because there are certain companies that will go from different series rounds, which we'll talk about just in a bit, straight to public IPO. And that is very, it's subjective. You'll see what I mean. I'm getting ahead of myself, but this is my first presentation, so cut me some slack, all right? All right, so we've got private equity. So private equity is exactly how it sounds. So private equity, private assets, not accessible to the public. like a public equity, we'll think like common stock to shareholders listed on a stock exchange like NYSE, like NASDAQ, all those other ones. Private equity is more so something that the firms deal with. And so those shares are acquired through different funding rounds, and we'll go over the funding rounds later. But most companies start as private equity and then transition to public equity through an initial public offering. So some private equity companies, you can think about the different types of business organizations. We got like LLCs, we got partnerships, all those different, business entities, even corporations can be private. But they usually want to transition into an IPO because that's where they get the most investing in. They can, help themselves with the most amount of funding from the public. So private companies are also not necessarily smaller than public companies, but they are more exclusive to invest in. So think about this, Tesla is one of the biggest, they just lost 50% year to date right now, so that's not that good. But they're one of the biggest public companies. They were private at one point, as is most companies. Apple was private at one point, Microsoft, Amazon, and so they all had to do their own funding rounds to become the companies that you know and love today, or know and hate, depending on what your opinions are of those. But we'll think about, so think about these, like private companies that are big right now. Think Plaid or Plaid and SpaceX, right? Those are private, but they're not smaller than some of, there's micro cap public companies. Like you look at some biotech companies in the hundreds of millions or even the tens of millions of dollars in market cap. These companies are currently valued in the billions, but they are private, and so they're big. There is no clear-cut way to run a PE VC firm. This is more applicable to a VC firm because PE firms are typically a lot bigger than VC firms because these are like large institutions of high net worth individuals. And VC firms, that's not saying that there can't be any high net worth individuals working in VC. It's just typically these ones are going to be bigger. The PE is going to be bigger than VC, but that's why VC is a component of PE. It's a little weird of a relationship. There's a high risk in PE and VC as opposed to public equity. So this one, it's this point right here, like I said earlier, risk is subjective. So typically VC has the most risk, and then it goes PE, and then it goes public equity. So we're going to look at venture capital now. So venture capital is defined as capital invested in a project in which there is a substantial element of risk, typically a new or expanding business. VC firms typically identify startups with high growth potential and seek to invest in them through the allocation of their limited partners' capital. VC firms usually specialize in seed to Series A investments and pre-seed. I should have put that there. So they receive their funding through partnerships with LPs, the limited partners. If you took business management, then you should know, their LPs are limited. They don't have liability because they are just contributing capital, and it's up to the general partners, founding partners, operating partners, all of that in a VC, which we will get to in a different presentation, to allocate the limited partners' capital accordingly. So the funding rounds in private equity, this is one of the best parts. This is really interesting here. So we got pre-seed, which is going to be, we'll get into it more, but pre-seed, seed, Series A, B, C, D+, and this can pretty much go up to any letter, and then IPO, which is initial public offering. So this is the relationship between the funding rounds. So the green line I wrote, and this is very, rudimentary. I don't want you guys to take this take this with a grain of salt. This is just typically how I view the relationship. So the green line here represents the potential and the risk for profit. So if you notice here, pre-seed is the highest risk, but also the highest potential profit, right? But they also don't raise that much funding. So that's why these are, inverse of each other here, the relationship, because as you get into IPO, you're going to be raising a lot more money, but the firms aren't going to be making as much in profit from flipping their shares. So here's a little timeline that I made. This is based on the average funding rounds from 2020 to 2021. The data was collected online from Investopedia. I used some median and some mean. I think I used the median for Series D, and then the medians from pre-seed to Series C, and then the means from Series D to IPO. So here's the pre-seed. Pre-seed, as you see right here, it's the earliest stage right here. So this is going to be companies that kind of don't really have much, and when I say that, I mean sometimes they don't even have a product. They might just even have a team, or sometimes they don't even have a team. Now you might be thinking, well, that's probably not a good investment. right? Because they have nothing to show for themselves. But that's where the team comes in. So you want to make sure in the pre-seed stage that the team that you're looking at this company is a solid team with a good track record. They're probably not going to raise much money if they don't have a good team, or if they have no track record at all, because why would you trust a business that has not proven themselves in any way? So we see here, founders are typically first getting their operations in order, like I said, and may not even have a product yet. Riskiest, but also most profitable investment round. Businesses need the most help during this stage because, once again, they have pretty much nothing. Sometimes they have no inventory, they have no IP, so intellectual property, no patents, no nothing. Just a good team. Hopefully they have a good team. So now we'll go next. The first official equity funding stage. This is seed. Now, why is this the first official stage? Because pre-seed is technically like something that's not really, it's from the VCs that I've talked to, they identify pre-seed as something that is a component of the startup funding process, but it is not something that a lot of people pile in. You don't pile into a pre-seed round. There's just like a few companies that do pre-seed because it is so risky and they have no product. But seed, it's like kind of, their real starting point. If this is the baby being born, then this is the embryo, if you kind of see what I mean. So it's called seed because this is the planting of the tree. Or the beginning of most companies, yes. Financing the first steps of a company, yes, it's a seed. Helps a company determine its final products, target demographic, and establish a founding team. So this right here is a very important step, because if you have no idea what you're doing, I would assume most companies, and this is highly subjective information, by the way, a lot of companies operate differently depending on their funding rounds. But usually by the time you get to the seed round, you have some idea for a product, some team, you have some kind of strategy, you have identified your market, you have revenue projections for whatever product that you're trying to create, and you're taking steps. So this is a very big, very important first step to expanding your business. Seed rounds consist of multiple investment firms contributing capital to a company in exchange for ownership share and a board position. So one of the relationships that you'll see as we go down this line here through the different rounds is that as we progress down this line here, more investment firms will be piling in. Hence, you see why there's so much more money, and they're willing to contribute more capital, depending on if the business is becoming revenue positive, profit positive. A lot of them won't probably become profit positive until like here in the Series C round. But you want them to be establishing some sort of revenue, some sort of plan moving forward. And as the plan starts maturing, more investment firms start looking at the company going, hey, maybe this is something that, we should be investing in. And so you're going to see more money being contributed. Seed rounds consist of multiple. Did I already say that? Yeah. The median seed investment for 2020 was $1 million with the median. This was, the median seed investment for 2020 was $1 million, with the median seed valuation being $6 million. So there is a difference between these two. Let's say that you have 6 firms contributing, or you have a firm and you value a company at $6 million. Well, hopefully, depending on if you've seen, something like Shark Tank, they'll contribute $1 million for a certain percentage of the company. That would be the $1 million for the percentage in the seed investment here with